Welcome to Beyond the Block, a Web3 focused podcast where in each episode we'll explore a topic impacting our industry. Joined by an esteemed industry colleague, we'll dive deep into how it's driving our businesses. This is, of course, all powered by Kadena, the only truly scalable Layer 1 proof-of-work blockchain. Let's dive in.
Hello, I'm Annelise Osborne, Chief Business Officer here at Kadena. We're very excited to share with you one of our new advisors to the board is Nitin Gaur, who is an exceptional thought leader in the digital asset and blockchain space. So Nitin, thank you so much for one, joining the board and helping us out here at Kadena, and two, for speaking with us today.
Annelise, thank you once again. Looking forward to this conversation. I've always enjoyed my conversation with you, whether it's at the event and at my own podcast. And also, I think the time that we spent in New York last week, very exciting, and looking forward to a bright future with you at Kadena.
That's fantastic. Well, first, I would love to, I will say that we met years ago at Consensus. I was always impressed that Nitin ran digital assets at IBM, which was for a number of years, and then moved over to State Street and ran digital assets there. I would love for you to go ahead and share your history and what you've done. I will also say you have an outstanding podcast, which I listen to and really appreciate, and as well as you profess multiple places around the world in different universities. So shaping young minds as well. So thanks for all that you do, and that you have a wonderful book that's out there.
Of course. Thank you so much. And so same to you as well. Annelise, your book actually talks a lot about cultural shifts, which I'm working on now on a paper that describes exactly that at a technical level. But a little bit of history, right? I was at IBM, I was tasked with future of payments, which is I had designs for Apple Pay before Apple Pay was out. And there were some interesting challenges. In that context, I met close to about 60 plus different payment providers around the world. And that includes Master Visa, which is payment networks, and banks and card issuers. And Bitcoin kept popping up. So came back from my travels, locked myself in my office for 3 months to fully understand what is this thing. And then it clicked for me. And I spent about almost a decade at IBM, not just championing Bitcoin, but also building an organization that led to the 90% of world's banks that were using our technology. And so if you look at the older system, the payment systems, the core banking systems, these came from IBM. And we were very much involved in not only deploying them, but also in the process of building middleware that reduces the cost structures of running a financial institution. So we were very much entrenched in that ecosystem of the past world. And when I saw this Bitcoin, which is more of a transaction system, big selling point me to IBM leadership was that we need to invest into this because it really hurts us because we are the purveyors of transaction system and technologies as it is disrupted to banks, because at some point that business model gets disrupted too. And this was in 2012, 2013. And long story short, it was an amazing journey, 1,200 POCs, 99% failures, which I wear as a badge of honor because you knew what worked, what didn't work from that perspective. But largely the focus was interoperability with old systems, technology systems that need to be built. And then eventually I was working with some really cool project with US Treasury, because a lot of repo markets that actually has all kinds of challenges in terms of reconciliation and mobility of the liquidity between the large financial institutions. And in that context, I had the opportunity to work with State Street as an IBMer. And when the opportunity presented itself, I shifted to State Street because, one, it is a GCFI, which for the audience is globally systemically important financial institution. But more importantly is that these are entities that do the mid-office, back office, the boring stuff that really fuels the engine that is known as Wall Street today. So all the capital market infrastructure, all the various market participants, they rely upon ensuring the accurate reporting of assets, the accounting of assets, the custody of assets. And all these are done by just a handful of banks around the world. And I viewed this as an opportunity, Annelise, to understand the financial markets from inside out, because many of the DeFi protocols, as we know, don't fully understand what they're disrupting. And I felt that it's important for us to understand that. So I'll pause here. That has been my journey. It has been super exhilarating, both in terms of amount of learning, but also ability for us to influence the shaping of the new financial market infrastructure, if that makes sense.
Sure. Can you share, you commented on DeFi not knowing what they're disrupting. I really believe that DeFi and TradFi are really building some of the same things. They just look at it differently. It's just and that will merge. So I'm a believer in institutional DeFi coming. Can you share about what made you leave IBM and go to State Street?
Yeah, so IBM began to focus because it's a tech company and they wanted to make money from technology. Whereas I think blockchain and blockchain fueled ecosystems are more about building ecosystem, building new financial products. So we were not able to make the kind of quantum of revenues we were expecting from blockchain in general. But my thesis was that blockchain has a drag on effect. That you build this on cloud infrastructures, you have security, you have HSMs, you have all these different technologies that go into it, and you have to shape it. And so the shift from IBM, which was then the focus shifted to cloud because IBM acquired this $32 billion acquisition with Red Hat, and the entire focus of the company was to monetize that. And eventually the technologies like blockchain became sort of sidelined, and I needed again to build that momentum. And also I was getting too comfortable. I spent 22 years, Annelise, even though I changed a lot of divisions, departments, and thankful for the opportunity that IBM gave. And State Street reached out in my past work I was doing with State Street to say, hey, come and build this for us. And so I had to pursue that passion to say, hey, I need not just the support and sponsorship from a large corporation, but I also needed to understand and fuel that ambition of building that financial infrastructure that I sought out to do at IBM. So that was a shift. Thankful to both the companies, IBM and State Street, for the opportunity. Learned a whole lot during the process as well. And I do agree on the convergence, which we'll discuss more on this podcast later on, is the DeFi and TradFi. And I also believe in the same thing, that these two should converge and will converge, as we've seen in other areas as well.
Great. And then can you talk about your leaving State Street and your next chapter that you are working on now, what you're developing?
Yeah, so it's also interesting because State Street went on the same path. There was SAB 121, there were a lot of regulatory pressures. And if you were to build a new division, it requires that you build an army and you have to feed the army. There was all kinds of challenges in terms of justifying the funding, which is understandable. And so I took a bow, and I also took time during my time at State Street because I was working with our cohorts, which is the other GCFEs and the investment management community, to be able to understand why are we still stuck in POC phase. Because in my IBM days, I did 1,200 of those. And I'm like, I don't want to do POCs anymore because we know things work. So what is the reason why we are still doing POCs? And I realized that, exactly to your point, that we do need to ensure that the digitization of existing assets, this is the RWA or real world assets domain, and the crypto world, which is the fifth asset class, as we call it, the new asset class that's entered the financial realm. They all are on this new financial infrastructure, which is blockchain as rails. And blockchain itself is an accounting system. But I believe that the existing financial infrastructure, which, again, the $500 trillion worth of bankable assets that are in the system, are accounted for. They are tied to various multiple accounting book of records. They're tied to liquidity management system. They're tied to treasury management system. And these systems are regulated systems. And I realized that for the traditional financial institutions to consume this newer technology and new asset classes, they have to bridge the gap between the old and the new for some time before we transition out from the old to the new system, right? And so I'm building LedgerLink, which, as the name suggests, is linking the two worlds, the old and the new, to ensure that the regulatory apparatus and the responsibility, the fiduciary responsibility and prudential regulation that the banks have to maintain is still preserved. That if you're still taking a tokenized asset, whether it's tokenized bonds or tokenized securities or Bitcoin, there is a mechanism for us to account these in existing accounting book of records, because that's how a bank is able to prove to the regulators its health and its prudential treatment of assets, and ensure they have adequate liquidity to meet the short-term obligation that's required by law in pretty much every modern economy, in the world today. And so LedgerLink is aiming to bridge the gap to ensure that banks are able to consume digital asset without changing its operational framework, and provide an integration framework from the tokenized assets to the traditional digital infrastructure that has been governing our financial system today. So that's in short. But I'm super excited because I figure it's boring, I think, Annelise, but someone's got to do it. I believe it's boring tech. It's integration. It's not exactly something people talk about in parties, but I figured that it's needed for the financial industry to move forward and with ease, consume digital assets.
So is it like an API that you're plugged into the different chains, and it's an API for institutions to plug into, so easier for their systems, like a Plaid, for example?
Similar to that, except that we're using the back office system still uses what they call messaging systems. So as many of people who are familiar with the industries know, there are all kinds of messages, whether it's IFIX, which is the Financial Information Exchange Protocol, or ISO 20022 or MT protocols. These are messaging protocols, Annelise. And the way we've crafted the existing system, which is the old system, is nothing but a fragmented financial ecosystem that's tied through these secured messaging that happens between financial institutions to not only send information about the asset and about the transaction, but also move the asset through these systems. And we are piggybacking on the same technology. An API becomes an interface, but behind the scenes, the idea is that I receive an asset, I understand what the asset is, I understand the value of the asset, and I create a message that's easily understood by existing financial system. And that's why I want to coexist till we slowly move the micro infrastructures of each assets to blockchain. And so I believe that you need to sort of coexist for a brief amount of time. And I say brief, it's a decade or two, I think, before the entire world moves towards the blockchain ecosystem.
Before we stop talking about blockchain and the world is just...
That's correct. That's true.
I would love to. So fantastic. I'm really excited about LedgerLink. I would also love to hear about your takeaways from State Street and digital asset adoption in the world of how do we create digital assets as more mainstream. What are some takeaways that you learned from State Street?
Yeah. So one thing is, I think digital asset is inevitable. That's one. Second thing is digital currencies, tokenized form of fiat, whether you want to label it stablecoins or tokenized deposits or CBDCs, are inevitable. Only because we are inching towards the velocity of asset movement. That is what happens. So I broadly classify this adoption rate from the large financial institutions and mid-sized financial institutions in two buckets. One is transformation and the other is disruption. And the way I look at transformation is there are all kinds of challenges that large financial institutions have to endure, things like reconciliation. Believe it or not, large financial institutions still hire armies, if not a few thousands of people, simply to reconcile spreadsheets to maintain an end of day position for a fund or a specific lending instrument. And there's armies of people still involved in ensuring that the back office system, which is core banking system, still has the right amount of lending and the fund statistics that needs to be maintained for n number of reasons. So transformation to me becomes that if I can adopt DLT, blockchain, and all the constructs, the digital assets, then you take away a lot of internal challenges of an enterprise. And if you can solve the issue for yourself, it's also evident that whatever State Street has a problem, BNY has the same problem, and JP Morgan has the same problem, then you suddenly are going towards a network effect by solving your own problems. You're building technology, you're proving a tech stack, and then eventually propagating the tech stack to the rest of the industry, and you're solving the industry problem. So that's one, which is a transformation camp. And all this becomes relevant the moment you look into tokenization of real world assets. And if you look at that industry in the last year alone, we are reaching close to about $150 billion worth of real world assets being tokenized. There has been a conversation around $1.5 trillion worth of reverse repo facilities, which is the repo of liquidity between the financial institutions. All these are going towards tokenized form. So to me, that's transformation, because you're using technology to transform an aging financial infrastructure. And the question then becomes is that a path where you can apply technology to solve a real problem? Because now suddenly I can put an ROI on this. I can say, by doing this, I'm saving the organization. Even if I save 10% of my existing full-time employee cost and the adjacent cost that goes with maintaining an army of thousands of people to maintain reconciliation, well, that to me is transformation. The second camp, Annelise, is disruption. So if you look at Bitcoin ETF, Ethereum ETF, I put them in disruptive, camp, where suddenly now you have a new asset class, and again, the financial industry is neither immune nor new to emergence of new asset classes, whether these are derivatives or whether it's an ETF. ETFs are fairly new. It was in late 80s when ETFs were introduced by State Street, and you have all kinds of new assets, the collateralized debt obligations, which was the cause for the 2008 financial crisis. These are all new instruments. So financial industry is not alien to new instruments, but suddenly now you're dealing with a tech-heavy. Bitcoin is a new asset class. It's a new instrument. But the rules of engagement, because it's a protocol, the rules of engagement are quite a bit different from you constituting an asset class and using the same apparatus of fund distribution or fund accounting to launch a new product. Suddenly now the rules have changed. So the financial industry not only have to keep up with adopting and adapting to blockchain and DLT and cryptography and wallets, and these are the new constructs that the asset class embodies, but also figure out as to how do you monetize this. So to me, I don't think Bitcoin needs ETF. I think ETFs were crafted for the pension funds and hedge funds to provide an exposure because they are comfortable with that structural asset and the market structure that governs it, and the parties who are held accountable for it. So I believe all this is disruptive angle where every bank, every financial institution is now figuring out as to what they need to do, whether they need to have an on-ramp, off-ramp to the infrastructure, which is public infrastructure, which is blockchain networks. They need to have a robust custody system because the risk is a bit higher, which the banks are not used to, that suddenly if you lose keys for public assets or these crypto assets, it leads to permanent loss of assets, and banks are not used to that level of risk. Yes, there's liquidity risk, there's market risks, there is counterparty risk, but this is a new risk, and banks are trying to understand these things. So I'll pause here, but these are the two broad buckets I've categorized. And the challenging thing for banks is they have to figure both at the same time, because both represents not just a massive market opportunity, but the fear of being left behind is another challenge that banks are saying we need to do something about this. Otherwise, we become irrelevant in the next decade or so.
So your comment on Bitcoin being a new asset class, do you look at Bitcoin representing all cryptocurrencies? Or do you separate that out?
I do separate them out. I use actually Bitcoin and Ethereum as a starting point, and I'm not a maxi for any of the protocol. I've been a technologist. I look at simple things like consensus mechanism. I look at performance. You can say I geek out at times, as you may have seen that last week, glimpses of that, Annelise. But I'm not a maxi of any kind. I do believe that Bitcoin and Ethereum, I use the term structural asset classes because Bitcoin being the first of a kind and the highest market cap, it's a little over $1 trillion today, represents a movement, but also represents a massive innovation that the industry has got through. And I also classify Ethereum as a structural asset because Ethereum brought the programmability, which Bitcoin was lacking in the space. And that has led to this, at its peak, $3 trillion asset class that was born out of pure tech and a community movement. And if you look at some of the stats, if you look at many of the thought leaders, my cohorts in the space, Balajis of the world, who are comparing Bitcoin and Ether to nation state status, that these networks they don't have any borders. They attract capital and talent from all around the world. So the rules of engagement are suddenly egalitarian, that if you had an Ether, the ability for you to engage in a smart contract, which represents a financial instrument, is exactly the same whether you're in Cambodia or whether you're in Uganda or United States, which is not to be said about our existing financial system. So it is inflicting upon that shift that we begin to see in the industry. And that's why I think all layer one blockchains represent that potential, that promise to level the playing field. And not only it creates a marketplace for the closely approaching 9 billion world's population, but it also creates immense liquidity in the system because suddenly now you have much more larger class of participants coming into that ecosystem, which is governed. So I use the word structural asset because they do provide a structure to whether it's creating programmability around different asset classes and creating exchanges and all the other smart contract driven financial market infrastructure and financial market instruments. But Bitcoin itself provides a massive amount of liquidity, which allows a fungibility to exchange Bitcoin for other asset classes, which is why I use the term structural assets, if that makes sense.
Sure. Can we dive into the tokenized treasury world? One, why do you think tokenized treasury is so big? And two, who's buying and where is it going to go?
Yeah, that's super interesting. In fact, when I moved to State Street, one of the reasons why, because I was working with the US Treasury from IBM perspective. So as a large corporation, we were invited to help the government apparatus understand the risks, what we are doing from technology perspective. So we engaged in some super amazing conversation at a lot of agencies that I didn't even know existed at the time in the country, trying to focus and trying to figure this out. So regardless of what people hear about SEC and Gary Gents of the world, there's a whole set of really intelligent people behind the scenes who are figuring this out and approaching this in a meaningful way. So U.S. Treasury, U.S. US dollar has the privilege of being the world's reserve. U.S. Treasury has seen a sort of a reserve asset class which provides some level of stability, both in terms of investable asset class, investable instrument, as well as a safe haven for people to ensure that you don't sort of lose the value of money. So it becomes a store of value, sort of an asset class for the rest of the world around the or rest of central banking around the world. And of course, that has come under massive scrutiny lately because of, again, hyperinflationary challenges, the amount of $4 trillion that we have introduced in the economy, and the recklessness of, or at least perceived recklessness from the U.S. Treasury or the Federal Reserve in terms of issuing sort of new currency in the system. So there's a whole kind of geopolitical, macroeconomic forces that are at play. And there are also challenges where the consumption of U.S. Sort of tokenized form of U.S. debt, whether it's securities or T-bills, or even U.S. dollar for that matter, is come into focus where can we achieve additional transactional efficiency. So as you know, one thing that Bitcoin does, or tokenized asset does, it allows for things like transactional efficiency. Certainly I can move asset in real time at the speed of light. I don't have to deal with the back office reconciliation that banks have to do, or I don't have to confine to a trading window, which usually happens between 9 to 5. I have 24/7 markets. But at the same time, I can fractionalize these things. I can collateralize these assets. So tokenization provides all kinds of transactional efficiency from that perspective. And because it's a high quality liquid assets, which means it could be used in lieu of payments, not in the United States, of course, because of some regulatory challenges, but of course in Europe, you can use many of the treasury instrument as a payment instrument. Suddenly it provides the increase in velocity of asset, it provides injection of liquidity in largely illiquid markets. And I believe that tokenization of US Treasury, as we have seen with BUIDL, which is the fund from BlackRock, and we've seen with Ondo Finance, we've seen a bunch of tokenized security projects around the world, is aiming to figure out to capture the small piece of that market to not only prove the point, but also there's a lot of business because suddenly you have the velocity increase, which also increases the utility of the asset class, which today takes a day to clear. And suddenly now I can use the asset class to be able to move the speed of wire. Those are the drivers of why these are going. And it also has regulatory clarity. I mean, at the end of the day, all you had to do is provide a mechanism which provides a tethering of these tokenized assets to a back office system that provides a 1-to-1 ratio. The proof of reserve, the accountability is there. So it provides a lot of building of apparatus to drive these assets into the mainstream financial system. So these are, I think, some of the contributing factors that leading to simply going after stablecoins or treasury because it provides that clarity.
So what do you think about if you look at when we had some bank failures recently, right? We had SVB, what have you. And a lot of that, we were in an inflationary period where interest rates were going up. And so banks a lot of times buy treasuries because that's how they, if someone's pulling money out, they're dealing with having to, and selling treasuries at a discount. So do you think perhaps if the banks were using a liquid treasury fund instrument where they're still getting revenues, it's stable backed by treasuries, that would have decreased the discount from which that any of this was sold because they're short term, and maybe we wouldn't have had banks go under?
So I'm not an economist, but I did spend a lot of time studying, the Silicon Valley Bank, SVB. I actually even helped them get account with some of my own connection at the time. So I'd spent actually a lot of time understanding the economics of it, Annelise. And I don't think tokenization would have helped that because we use the term duration risk. So many of these banks actually had long-term securities which had certain maturity levels, which means that your lending and maturity with coupon payments actually happen after some time. Until then, the assets are either illiquid or you're selling at a discount. Now, in many cases, in case Silicon Valley Bank, they did have hedge against the duration risk, which they decided to sell in open market, which I think was a mistake that they made, which led to the entire fall of SVB from that perspective. That the risk and compliance had professed a model to deal with some of these challenges, and if you let those hedges go, then you are. But I do think that tokenization would have provided some level of clarity to the government, because by the time the information is consumed by the regulatory, the Treasury, the Federal Reserve, and the entities who are ensuring that the health of our financial system and the resiliency of financial system is preserved, there's a time lag for that. But I believe the moment you digitize and tokenize these things, you have access to real time avenues to understand the impact of moving these securities. And you also have access to having a counter to even the hedges, for example, which were bought against these long duration sort of assets per se. And I actually have had this conversation in one of the meetings with the Federal Reserve. There was a meeting with central bank a few months later in Philadelphia, and we actually had this conversation to say, how do you these are for the chief economists who are tied to these large central banks, to say, if you had access to real-time information, would you not make decisions better? Because oftentimes the interest rate decision, for example, it has a massive time lag by the time the decision is made and by the time you see the real impact of those decisions on the economy. And I believe by creating this access to tokenized finance and access to the real-time data that pertains to these technical infrastructures, I think it really empowers the decision-making capabilities for the economist class who are tied to central banking, who are tied to treasury, who make decisions around these areas, if that makes sense.
Sure. What about stablecoin? How do you see stablecoin outside of U.S. treasuries, but actual stablecoins? I guess, what are they? Where do you see them proliferating? Do you see them kind of as the future of money? What do you think?
Yeah, I think so. I think USDC, USDT, and the global consumption of stablecoins I have personally been engaged in it for past 8 years in figuring out not just the business model for stablecoins, but why they're important. So one thing is fungibility that US dollar provides. It's well understood. You can't change the world to swap to Bitcoin, given the price volatility and the technical barriers of a common man's understanding of Bitcoin is still a challenge. The usability and UI UX is still a challenge. But people understand dollar. They understand the difference between a physical dollar and tokenized dollar, that it's just a form factor and modality that has changed. So I believe that alone, the understanding of how a dollar works or how a fiat system works, will lead to a massive adoption, which we have seen, I think, by June or July this year, by 15 July, I think the stablecoin transaction volume had exceeded the typical $7 trillion, which is what Visa processes. So obviously, there's a whole lot of consumption, a lot of transactions happening with stablecoins. But I've written a paper on this topic, Annelise, where if you look at the advent of stablecoin, the reason why stablecoin came to crypto, because crypto needed a fungible instrument to solve the duality of a transaction. The people are transacting left and right at a speed, at the instant settlement with crypto assets, and they needed something to provide an exchange mechanism, a medium of exchange of sorts. And stablecoin was born for people to be able to bring the US dollar into the system and suddenly use the US dollar to buy and trade and sell the crypto assets. And I believe that fueled participation from say 30 million to close to over 1 billion people who are on the system is because of the stablecoin per se. And I believe inverse will be true in the real world, which is the transformation bucket that I listed earlier, Annelise, that the moment stablecoin becomes mainstream in traditional finance, you'll find it'll really speed up the tokenization of the 4 asset classes, the private markets, the bonds, the equities. We see glimpses of that now, but the moment stablecoin becomes mainstream, whether it's Stablecoin Act in the US or MiCA, who has provided some clarity on stablecoins, once you have the regulatory clarity and it really the expansion of stablecoin becomes mainstream, I believe that'll be the inflection point that we'll see of that transformation happening from now people natively issuing tokenized securities or tokenized private equity or tokenized bonds, because now there's familiarity with tokenized money form. And I'll say this, that my first asset class that I'm targeting for LedgerLink is also stablecoin, because my simple ask from banks are, forget about bonds and tokenized XYZ, more exotic assets. Can you be a bank? Can you simply receive money, deposit it, keep it safe for me, and give me interest? Can you just do what banks do? And if stablecoin becomes a reality, then every single bank, 11,000 on Swift network, 6,900 plus banks in the US, they all have to be ready for that apparatus, that infrastructure. And once you have the infrastructure in place, suddenly you can see as to how I can cut and paste this technical architecture to be able to start consuming and adopting digital assets and tokenized form of assets.
So stablecoin increases the velocity of money, which I think is a huge recognition. And so do you think that from an institutional perspective, that people or banks will be using USDC? Do you think that they'll come up with their own JP Morgan coins? Can you talk about kind of internal
Yeah.
public-private stablecoins?
Yeah, so two things with this. Right? One is JPM coin, which is actually not a coin. It's not tokenized form. It's more of a ledger entry on a sort of a lineage of innovation they had done inside of JPM. So it's still a closed system, and I believe I've been part of many conversations and projects, in the past, I would say 15 plus years, where every large bank has contemplated having its own stable coin, so they can basically achieve transactional efficiency that most large banks still use Swift, even if they have to move money between their own two accounts. So if I have an account A, account B, I still have to go through Swift, which has this cost and time, and the whole issue of time and trust becomes a challenge. So I believe that most banks large financial institutions will issue a stable coin to achieve the transactional efficiency, achieve the transformation bucket of not relying on reconciliation, not relying on this huge cost that the payment networks like ACH and Swift incur because of their own processing overheads that goes into the whole thing. And I believe that once you have large financial institutions are able to issue stablecoins of their own, and because they are governed and they have regulatory clarity, which means they have to ensure that the money supply is not changed, which is the central bank's agenda, then suddenly now, let's say JPM coin is fungible with BNY coin, or is fungible with USDC, or is fungible with State Street coin, because they all are dollar denominated and they work in the confines of a framework that's stipulated by U.S. Treasury, or let's say Federal Reserve, because both will have a say in it. One is concerned about money supply, one is concerned about financial resiliency. But I believe that I can see that happening. I certainly don't see, at least in the Western Hemisphere, where a bigger concern is around privacy and around programmability, which leads to Big Brother watching where you're spending your money narrative. I still believe that the banks will issue their own, initially for transactional efficiency between their own four walls, but eventually that's seeping out to the partner ecosystem, whether investment managers or whether the smaller banks who do wholesale banking with these large banks. That's how I see that being more ubiquitous. And even for that, Annelise, what you're working on now, what I'm working on now, they will need some infrastructure to move that. And the question then becomes, who can provide a low cost, a resilient infrastructure with a faster time to market to be able to facilitate them issuing these stablecoins?
Okay, so it's not, what I'm hearing is that it's not every bank issuing their own banknotes like pre-federal currency. It is more people having, or banks having their own depository receipts, which maybe member banks that have accounts could potentially use. So working
Correct.
within the ecosystem. Okay. Yeah. Shifting a bit, let's talk about proof of work and proof of stake. So Kadena is a proof of work. We look at it from a security perspective. We recognize the benefit of that. How do you see most of the ecosystem has gone to proof of stake? How do you look at those two structures?
Yeah. So at a technical level, right, there used to be something, and I'm going to go about this a roundabout way, what the blockchain community calls trilemma, which is figuring out and what the traditional distributed computing world called Brewer's theorem or CAP theorem. They mean the same thing. Essentially, you're dealing with this massive expanse of decentralization and ensuring that when you decentralize this at a global scale, there are physics at play, because you can only transact. Your only limiting factor is speed of light, because assuming that the large lines of the world is connected through fiber networks, they have to travel a certain distance. It takes time, and if you have to coordinate the transactions between all these different systems that are involved in processing transactions, which is what consensus mechanisms do, they achieve a transaction finality, and there are n number of protocols that are involved in coordinating the actions of these various machines. That okay a transaction, the transaction eventually gets committed to blockchain. So proof of work, before I go into this whole thing, relies upon the same limitation of the CAP theorem or the trilemma, is that if you have an expansive decentralized system, scalability becomes a challenge, because now I have to coordinate between systems across the world. The world is big. It takes time for these coordination systems to communicate. And eventually dealing with, safety of the transactions themselves, which means that just want to make sure that they're safe. And the proof of stake came about because it was becoming untenable for proof of work system as an example for Bitcoin. It says, look, if it takes 12 to 15 minutes to process a transaction, you can't really achieve the level of global scale of payments, which is sub-second response with the Visa card, MasterCard networks. So whatever system we're designing to disrupt the existing system has to be cheaper, faster, better than the existing system. And if credit cards and point of sale systems are providing a much faster value proposition for me, blockchain falls short of that delivery, even though it's decentralized, it has own advantages, it has access to financial system and financial inclusion, all those narratives, but you still are preventing the access to the whole thing. So proof of stake was designed to solve the scalability challenges. But of course, the whether it's trilemma or whether it's the Brewer's cap theorem, you can only achieve two of the three desired properties of a system. So I can either achieve massive decentralization, I give up on scalability, and I ensure massive decentralization, and I have protocols that can ensure that my transactions are safe, or I give up on safety and I rely upon scalability, but I also give up on decentralization. So there's a whole knob that no matter what you want to increase, something has to give for you to achieve one of those three properties. And so proof of stake was a novel way to say, can we still decentralize this and use not technical security or protocol security, but use economic security, which means that I'm now putting my earned ETH or earned cryptocurrencies in a pool, and that pool basically verifies and validates an asset, and the asset eventually and the transaction gets committed. So I'm not relying upon this massive coordination technologies that has to eventually deal with the elements of ensuring the coordination is there, is relying on this economic security to commit the transaction to blockchain. And that actually had worked well for Ethereum because they had this massive decentralization, but they also introduced now biggest concern the last 2 years since the Ethereum merged from proof of work to proof of stake is there are a handful of stakers now who have lion's share of all staking assets, which means there are, if you look at Coinbase or Lido, for example, they govern about 60 to 70% of the entire security of the infrastructure. So you can see how they've achieved speed, that now Ethereum transactions are sub-second response times, but you've given up on decentralization, which means that the network itself is at risk, because if anybody wants to take over any of the 2 or 3 large stakers, you can compromise the system, and that the moment you compromise the system, you can see as to the entire network valuation comes down to zero, only because the entire valuation of these cryptocurrency relies upon trusts. So you're addressing the trust systems that we're defining, and there's a balance. So I'll pause here, but also happy to opine on the direction that we discussed in terms of the opportunity, which means the best thing Kadena can do is look at the 17 different consensus systems and figure out as to what makes sense from a point of view and taking the best of breed, and can I have a mix of both, which I think is the direction that the technical leadership is heading towards, if I'm not mistaken, Annelise. But that's something which will be super interesting and engaging exercise to get into.
Well, we are looking at Kadena with the proof of work, which is what I was looking to dive into, about the idea of having, we have security, we have scalability, and decentralization. Speed is another comment that you had made, but in the securities world, do you need to settle instantaneously?
No,
so
not really.
I feel like from a payments perspective, it's a bit different from a securities. I don't think having a lag of 30 seconds, which is, let's say we're at 30 seconds. So there is a little bit of a delay in the speed perspective, but which Correct. We don't need to share with the world. But the idea of the trilemma, I feel like there's a lot. We're decentralized, we're scalable, and we are secure.
So all of my career, right? That's a great point, Annelise, that you make, because even if you look at the highest, which is during holidays, we always cite Visa, MasterCard as 25,000 TPS. The world doesn't need 25,000 TPS at the moment. So if you look at traditional finance, they're happy with same day settlement. So we don't need to go after, like, the system that I have built. The requirements that I've gotten from the businesses were, okay, if I have 300 TPS, I'm happy because I can still do my normal day-to-day stuff. It still solves the problem, which today is T+2, T+3 in some cases, and the world is moving towards T+1 since this March, as you know. The things becomes interesting, Annelise, when you're going after the true Web3 narratives. So all this is great if we are revolutionizing and sort of the existing financial infrastructure to say we got to change the way we do things. And yes, we can provide security, speed, all these things for bonds and all the micro market infrastructures for bond equities, securities, private markets. We can solve those problems with the technology that you're talking about at Kadena. The things becomes interesting when you're going with 9 billion people doing a peer-to-peer transaction for the new asset classes. This is healthcare records, digital identity, NFTs. When you get in the realm, I believe that'll. I mean, not there yet. I think it's still a few. I would say 5 to 10 years away from to achieving the true sense of what blockchain was meant to do. I think you'll reach those limits at the time because suddenly now you're dealing with 9 billion people around the world. They all have the need to use the systems to either monetize their acumen, their data. Suddenly, data becomes something of value, and we tokenize the data. So that world, as we know, is still emerging. It's then things become interesting, I think.
Sure. Okay, shifting back, recognizing we're getting low on time. The idea of institutional DeFi. I would love to talk a bit about this. Currently, at institutions, do they look at the blockchain on one side and then the traditional finance on another side? Is there a world where you see this merging? How do you think institutions look at this? One, we'll start with that. How do institutions look at internally with blockchain and traditional finance and the potential merge?
Yeah, I would say this excitement. There's a department in every bank called risk and compliance. That is the biggest impediment.
They rule the show.
In adoption, only because most banks are driven by risk and compliance, and for all the right reasons, because the cost of failures are so high, the fines are so high. And so I actually also wrote a paper on this for risk model framework. So, and a bank has all kinds of risk model framework for liquidity risks, market risks, technology risks, regulatory risks, reputation risks. They have all these, all kinds of risks that has to be considered. And I use the term that blockchain solves the issue of time and trust, which means that suddenly you don't need intermediaries. I can still rely on protocols. And at the end of the day, I'm compressing time because everything is near real time instant, which is not the case with traditional financial system. So when you increase the velocity of asset movement, when you increase the velocity of settlement, you have to now have your systems keep up with liquidity risks or settlement risks, suddenly because now you have new risk vectors. And banks have to be ready to understand the risks. And while many of them understand the liquidity risk and settlement risk, they don't understand the technology risks of what happens when a protocol is compromised. And they hear all these news about DeFi protocols being hacked. Sometimes nothing to do with DeFi protocol. It's the weakest link, which is a wallet of some kind with certain individuals, or some weak link in the entire value chain of the crypto asset movement. And to me, the impediment is figuring out and I believe that with the advent of data and AI and the massive advancements that we've seen the last 2 years in data processing and AI technologies, and I was working on that even my IBM days and at State Street days, is to apply AI for things like detecting financial crimes or liquidity management that I know. In fact, in LedgerLink itself, I built this module which allows for us to look at cash at hand, cash in pipeline, all the incoming, outgoing payments. And now that I know the settlement happens within a matter of a few seconds, what can I do to help liquidity managers and risk managers keep a real-time view of what they can do to stop payments? Because that happens all the time, that if you let all the payments go through and you don't have enough incoming payments, well, that becomes a risk for treasury and liquidity managers in a bank. That becomes an issue for securities lending and for collateral management, which is really the engine and the heart of the capital markets. People borrow and lend assets all the time. Unlike crypto, which is the problem today, assets don't sit in a vault. And it's only the DeFi protocols that are leveraging with creating secondary markets and ensuring that there's borrowing and lending happening for crypto assets. So for traditional finance to, they salivate on the potential of DeFi, but they also are a little afraid because risk and compliance don't understand this, and they will never agree to going onto something they don't understand. And so my perspective now, whether it's late stage of IBM or even at State Street, I would spend most of my time with risk and compliance to head on, like my first order of business, speak to risk and compliance, help them understand these things, because that really accelerates my ability to introduce technology and consume the technology and its potential in the space.
Great. What about institutional DeFi? How do you see that developing?
Yeah, that is actually a turf war. And I've had this conversation with various investment managers where if you look at the role of CSDs like DTCC in the US, centralized security depositories, they provide a function. They provide a function that allows this fragmented markets to function meaningfully to ensure that they have some liquidity and some assets, which means that if you're buying and selling securities, your orders are fulfilled, and there's a system in place which is governed by keeping certain liquidity or ensuring that you're providing a third clearing party to ensure the transactions get cleared. So for DeFi to really function, so let's get one out of the way, Annelise, that DeFi is disruptive in nature. It is a platform for disintermediation. So this complex financial infrastructure, we have broker dealers, custodians, fund accounting administration, transfer agencies, CSDs. For a single trade, some parties would have to go. Otherwise, why are we doing this, right? And the question becomes is who are those parties that will be the most impacted in this sort of evolution or tech-led evolution that is emerging. So everybody's doing their own experiment. So I would say that the biggest the biggest entity that's focused on this are asset managers, investment managers, because one, they can take more risks and they are okay with taking risks. They're less regulated, so they don't have to deal with regulatory headwinds that a bank like State Street or like a heavily regulated institution like GDCC has to deal with. And at the same time, the cost structures, they are the ones bearing the brunt of that cost, whether it's a fee that they have to pay or whether they have to pay a certain sort of cost of going through this entire ecosystem. So all the work Franklin Templeton, Goldman Sachs, and Wisdom Tree and they are doing is essentially is hitting towards that model for them to be able to drive. So that's where I think the puck is, and you'll see all this amazing work that's been done by the investment management and asset management community is to really disintermediate some parties, which will be interesting how this evolves.
You mentioned that intermediaries, Swift and DTCC, are actually really focused on blockchain now. So how do you see their role playing in traditional digital assets?
Yeah, so for traditionalists, I mean, if you look at DTCC, they perform a really important function. $2.4 quadrillion worth of assets go through their clearing system, which is a trillion of a trillion. That's how much they handle in terms of transactions. And as you take the advent of new technologies, there's always the fact that if we're not clearing for these assets, who is? Well, technically it's a protocol who's clearing it. But somebody's got to take accountability of the protocol. And this is the conversation that me and you are having, Annelise, when I should actually give a shout out to this book again, where you hit the cultural aspect of how do you make that shift? How do you make the shift from hoodies to suits? Because you need some sense of seriousness in this whole model, but it's all technology led. So a lot of executives, which is again from Silicon Valley era, all the hoodies, and they have to understand the financial markets. Same with what I'm writing now is what is the shift in that development practices? So the old world development that used to happen with whether it's waterfall or agile and how we develop code now for blockchain is completely different. And so the question then becomes is who's accountable for code? And I believe these Swift and DTCC like centralized entities or hyper centralized entities can sort of inverse the model that they can be the entities that become the engine of what the CERDIC of the worlds do is certifying smart contracts and ensuring that there is resiliency, there is security of this infrastructure that's running. So they can still play the role, except they will not be involved in clearing and settlement per se, but they can provide the infrastructure, a much needed secure infrastructure, which morphs their role, but it still preserves their acumen in understanding the industry and to say, hey, we can build a smart contract that provides the same function that 1,000 people we do and whatever we do with walls do, this smart contract can do. And we can connect to various crypto and digital asset custodians to ensure there's proof of reserves and there are guarantees behind the assets that are exchanging through the system per se. And that's how I see these entities evolve. I personally think, and this is my conversation with Swift too, Swift can completely implode and move from a point-to-point messaging system they are to a blockchain-based system, and no one ever has to know that they're doing that, if that makes sense.
Sure. Well, we are at the top of the hour. Thank you so much. One question I didn't ask you that we might get was about being a founder. So it is... So Nitin, what has the experience been like being a founder for a startup?
Oh my God, I more self-doubt than ever because you always question yourself because there's no one else questioning you. Less stress. I'm not dealing with the typical large corporation politics anymore. But also you lose a lot of luster because suddenly now you stop getting invites to be a keynote speaker because you're not tied to an IBM or State Street, which I'm okay with because just like you were saying, I get to sit and learn. I'm not always speaking anymore. I get to be in the audience and learn from other people's experiences. But I think it's an adventure, and I have learned a lot about myself. But yes, the only issue was I self-doubt myself every single day, and people tell me that's a good thing because you're not taking anything for granted. So that has been my experience so far. But I'm looking forward to next few years to build something meaningful because I always had this FOMO that everybody around me is building, and I'm just hanging with a large corporation and doing what I've been asked to do. So it's a little bit different mindset altogether.
Well, now's your turn. So
It's my turn.
thank you so much for taking the time. Really appreciate it.
Thank you.
This has been a great conversation. Thanks.
Likewise, Annelise. Looking forward to working with you and with the rest of Kadena staff.